Okay, welcome to the Flipping and Wholesaling Houses in New York show. I am Michael Pinter, where I teach you how to start flipping or wholesaling houses in New York, or if you're already doing it, how to grow your business. Now, got a very general question: how do real estate investors get financing? So, I'm going to talk about that's a broad. I could probably talk for an hour and a half on that topic, especially because I'm someone who came from the real estate financing world. Right, I worked in the mortgage business for 17 years before I started doing this full time about 10 years ago. Now, how to real estate. So if you stay to the end, I'm going to talk to you about ways you can sort of get involved in financing if you're something you're interested in. Now, okay, so there's two ways to. Well, there's so many ways. So there's real estate financing where you're trying to buy something and hold it, and then there's short-term financing for things that I do, right? So obviously, the real rich guys in real estate are the guys who buy huge buildings. Um, and how do they finance it? So the really big guys finance it, with very little of their own money. Right? I just read a book about Stuyvesant Town where the company that bought it, put up like a tiny fraction of the money. So what they usually do is they're going to get a bank loan for somewhere around 70% of the purchase price. And then if it's a small deal, they're going to put up the other 30% from their own funds. Um, 70 now there are exceptions. You can get 75, you can get 80. Sometimes the deal is a little shaky. It's 65. So let's talk about commercial real estate financing in this regard. So the real difference between residential financing, right, when you get a loan on a house, you're going to move into a 1 to 4 family house, you're going to move into, or you're going to rent, doesn't matter, um, is that the way the lender valuates the property is based on comparable sales. So if I'm buying a house and there are similar houses for sale, the lender's going to do an appraisal, and the appraisal is going to say, well, similar houses are going for $400,000. Your house is a little bigger, it's worth 405. Your house is a little smaller, it's worth 390. That kind of thing. It's based on comparable sales. But for commercial, and that means anything other than a 1 to 4 family, so I'm talking about even a mixed-use property where it's got a store downstairs and 2 apartments on upstairs, or 1 apartment. In that case, it becomes commercial. So anything more than 4 units, anything that's not residential, anything that's residential more than 4 units or not residential, so a store, retail, office, medical, industrial, warehouse, that kind of thing. Those get valued based on income, based on net operating income, the NOI of the property. So that's a big deal, right? So when I was in the mortgage business, I used to get calls all the time from people saying, "Hey, I have a mixed-use property I want to buy, and it's in Brooklyn, and they're all going for $1.5 million." And you give me the numbers, and I go, the bank's not going to value it at $1.5 million. It may be worth $1.5 million, but you're never going to get anywhere near that on financing because the banks look at commercial properties as the property being the primary source for repaying the loan. The income has to come from the property. When you buy a property, even if it's a 4 family that you're going to rent out all 4 units, the bank looks at you, the borrower, as the primary source for repayment and paying the loan. And therefore, they only look at what it's really worth if they had to sell it based on comparable sales. But anytime you're in commercial, it's only based on the income. So very often, people say, well, another property sold for $10 million, and then you're going to look at it and the income on it is much lower. Now, you can value add and increase the income, but you've got to make a real strong case to the bank that their income is way undervalued for them to give you the valuation you need. Another thing the banks want, so they want to see a certain cap rate on the net operating income. So we're gonna dive a little deep into commercial right now. So the net operating income is the rent, right? Total rent minus the expenses, right? Expenses are taxes, insurance, if there's management fee, any utilities or any other expenses the landlord pays, and then you subtract it out. They're going to give you a vacancy allowance because they're going to assume that some part of it could be vacant per year, and then you're going to net operating income. So let's say it's $100,000. So a commercial property is $100,000 in operating income. They're then going to look at what is the going cap rate in that area for that type of property, right? So if the property is really in a crappy area, they're going to give you a higher cap rate. Properties in a great area, they give you a lower cap rate. What a cap rate means is that's how they're going to figure out the valuation of the property. So let's keep going. Let's say the net operating income is $100,000. Very common cap rate today in a lot of the world, especially in good areas, is five cap rate. What that means is that you're going to get a 5% return if you don't borrow any money. So what that means is $100,000 net operating income is going to translate into a $2 million property, right? Because 2 million times 0.05 is $100,000. So if that's the standard cap rate, and you say, hey, this property is $100,000 in NOI and net operating income, they might value it at 200 at $2 million. Now, if it's a junkier area, there might be an 8 cap rate, so that property will be valued less. And if it's an amazing area, if you're on Madison Avenue in New York City, they might give you a 3 cap rate, in which case they'll value it more. Um, the basic way to figure it out, if you know a cap rate or you have an idea of the cap rate and you know the net operating income is, you just take the $100,000. I hope this is right, and you divide it by whatever the cap rate is. So $100,000 and you divide it by 0.05. I screwed that up. Sorry. 0.05 is $2 million. That's it. So that's how commercial properties are valued. So the lender is going to lend you a percentage of it based on their valuation. So I'd say the average is around 70. But it depends on a million other factors. It depends if you're personally guaranteeing the loan. It depends if you're not personally guaranteeing the loan. It depends on, are there vacancies there right now that scare the lender a little? Are all the tenants really good? Are the tenants crappy? These are all the things that go into it. They might give you more. They might give you less. Now, for the rest of it, there is something called mezz financing, or a second lien financing, where you can get people who will lend you part of that. Obviously, everybody wants the buyer to have some skin in the game. That's how. But in a large world, right, where you're doing billion-dollar transactions, there's going to be maybe 3 different levels of lending. They're always going to want the owner to put in money, but everybody will lend on it, right? Just because they feel like it's a trophy property, owner's not going to let it go, that kind of crap. Um, Now, for residential property, how do you get financing? So what a lot of people do is again, I'm a short-term real estate buyer, right? I buy properties. So I very often I'll go to contract and just wholesale the contract. I won't even close. So in that case, the only money I need is the earnest money deposit. It's very hard to get that finance, almost impossible. So you have to put up your own money. Um, if I close on a property, what I do usually is I take a hard money loan. Hard money lenders are going to lend you money for a short period of time. They want to get paid back in a year, 2 years max usually. They're going to charge you a higher interest rate, although the rates have come down significantly since I started. I think the first loan I took was like 16% with 6 points or something. Now I can get 8% with a point and a half. And they're going to take some points. Like I said, a point is 1% of the loan. So if I'm borrowing $400,000, each point is $4,000. If I'm being charged 2 points, I have an $8,000 fee at the closing, which really gets net funded out. It just means that instead of them giving me $400,000, they're going to give me $392,000. Right? You don't have to write a check for the points. It's just you have to bring the money to get the closing. They're usually going to lend. So in the great times before COVID, it was pretty much standard. It was 90% of the purchase price and 100% of the renovation budget. Now it's not as simple. If you're new, if your credit isn't great, you might get 80, you might get 70%. But if you're a seasoned investor, you can get 90% still today. 90% of the purchase price and 100% of the renovation budget, right? And how they're going to value it is they're going to look at an appraisal with your scope of work. What work are you planning to do to the property? And they're going to value it on a subject to or a ARV, after repaired value basis. And they're going to say, oh, this house, you're buying it for $300,000, but it's going to be worth $600,000 when you're done, based on you doing new kitchen, new bathrooms, and doing all this work, spending $100,000 on it. We're going to lend you somewhere between 65 and 70% of that ARV. But we want to see you put, if they're lending you 90%, they want to see you put 10% of the purchase price into it. Another way that people do it, and this is more popular outside New York, but it gets done in New York, is a private money lender. So I have some private money lenders where they will lend me 100% of the project. So I'm buying something for $300,000 and need $100,000 worth of work. They'll give me $400,000 for it, and they'll get a rate of return. I was coughing every time I talk for 10 minutes. Usually double-digit rates of return. They can say 10%, and they'll get paid. The good private money lenders I have will get paid at the end, so I won't be writing monthly checks for the interest. It'll just accrue. Most hard money lenders are going to want you to write a check every month for the interest. So that was really what I was talking about at the end. If you're interested in lending, right? If you're interested in private money lending, I have some private money lenders that are sort of phasing out, and I'm looking for money on deals that I close on. Usually these are short-term deals. You'll get a double-digit rate of return. You'll get your interest at the end. You're secured by the property. Um, there's very little that can go wrong. Um, I've never screwed over a lender ever. If you're interested, you can let me know. Shoot me an email or text. I hope this was helpful. If you're interested in all the ways I can help you, go to howtoflipnewyork.com. If you're interested in the course I have that teaches how to do what I do, go to howtoflipnewyorkcourse.com. If you're interested in finding out about coaching, one-on-one coaching, go to coaching.howtoflipnewyork.com. If you're watching on YouTube, please subscribe. If you're watching on any media channel, please click thumbs up, the like. The likes really help me. And please keep the comments coming. I post 5 times a week, and I need topics to talk about because I can't think of them all the time. There are no bad comments. You can ask a comment. You can ask a question about something that's not even a concerning the video you're watching. If it's an easy answer, I'll just reply. If it's something I've covered before, I'll send you links to the videos. And if it's something new, I'll do a video on it. So thank you very, very much for watching.